All right, today we're gonna go through the question. I've been saving quite a bit of money into my 401k. It's getting pretty big. I need to decide how much should I have in bonds versus how much should I have in stocks. And I'm not gonna need the money for a while, still a long-term investment. And there can be some really simple ways to look at it. One way is just, this is my age. And the younger I am, the more I'm gonna hold in equities. Another one can be time. Whatever age I am, I don't care. I just know I'm not gonna use that money for another 10 years. So I'm gonna have more money in equities versus bonds because equities outperform bonds in the long run historically. Those are two very easy ways to look at it. The difference between the two is that if you look at the age, say at 20, it might be 100% equities. Then you turn 30, it could be 90%, 40, 80%, something like that. So you are consistently getting more bonds as you get older. Or if you just use a time one, you might just always keep it 90-10. It stays the same up until the point where you know we're within a 10-year period of time before I'm gonna use the money. So those are two very simple ways to look at it. I'm gonna show some examples in a little bit more detail on how to determine maybe what you should have in stock versus bonds. You're looking at different economic cycles, business cycles. You're also looking at the stock valuations, things like that, just diving a little bit deeper into it. So stock value is the third one. Now I'm gonna start off to kind of make it easy, just give an example. So in the example, I want to look at today's S&P 500 top 30 stock and where they're each valued at. So in order for me to do that, what I did is I'm gonna take value of $100,000 and say I invest that $100,000 into those 30 stocks and I weight them based upon the weight that they are in the S&P 500. So as an example, if you have Apple, which makes up a higher weighting in the S&P 500, you might have a little over $10,000 in Apple. And then if you have like the 30th stock, it might only be $1,000. So that's how I invest that $100,000 into those 30 stocks. Now I take those 30 stocks and I look and go through the numbers to figure out what is the intrinsic value of those stocks. Intrinsic value would be just a financial formula that determines like what it would be the fair price to buy the stock at. If I didn't know what the market price was and I'm just trying to evaluate the company. In order to compare it, I want to look at two different time frames. One time frame would be in 2021. Another one, let's say around today in 2025. Each time frame was $100,000 is the value, which sets the price. We want to see what's the intrinsic value. In 2025, the intrinsic value of this 30 stocks of that $100,000 is $81,000. Whereas in 2021, the intrinsic value of that $100,000 was $123,658. So what does that tell us? Ultimately, if the intrinsic value, or maybe the fair value, the way to look at it, if the fair value of the stock is higher, that means that the price is underweighted and we want to take more advantage of being in as much equities as we can because it's underweighted. It's more likely that if it converts to intrinsic value, that we're going to have that gain. Another is in 2025, the intrinsic value or fair value is only $81,168, meaning that $100,000 is overvalued. We probably gonna wanna not hold as much stock because the stock is overvalued. A simple way to look at it would be, you could just say, I have a long-term investment. I'm going to hold 90% stock there and 90% stock there. But if you looked at, it's like, you know what? I wanna set some level of weight on the intrinsic value of my companies. In 2021, being that the fair value was a lot higher, you want to be as much stock. So you might want 100% stocks there. And 2025, that now the intrinsic value is lower, which would be an opportunity to take some of the gains because our value is higher. You say, we want to be in maybe 20 or 30% bonds. The point being that you would have some variability. You're not always going 90-10. You're using the intrinsic value as a measure on what you should hold in bonds versus what you hold in stock. So if the intrinsic value is low, you want to hold some bonds because stocks are overpriced. If the intrinsic value is high, you want to hold almost all stock because the stock is underpriced. Hopefully that's a good starting point and some examples before we get going into some of the deeper numbers.